I was only scared of Man during the Halloween movies, like the original Halloween movies back in the late 70s, early 80s. Jamie Lee Curtis. There we go. Okay. Who is ready to get going here, guys? Who is ready to get going? All right. So, as I've been talking about in the room, lots going on. Even though the market is pretty calm right now, we've got Fed minutes coming out in basically 1 hour. Okay. We've got NVIDIA and Salesforce earnings after the close today. And we've got really, really important inflation data, PCE, over the next couple of days. So even though things are really calm and complacent, which, you know what, we all like that in the markets when things are kind of calm and complacent, we could see some fireworks the rest of the week here. So we need to be ready. We need to be ready. And one reason why I wanted to talk about iron condors today, okay, is because when I look at both CRM, Salesforce, and NVIDIA for earnings, when I look at those charts, I don't really see anything that stands out to me. What do I mean by that? Well, let's take a look. Okay, first off, what is an iron condor? Combination of a call spread and a put spread. Iron means that we're on both sides of the ledger. Okay, iron butterfly, iron condor, iron anything means you have a combo of both calls and puts. Expiration is the same for all the contracts in here. Max profit between the strikes. Max loss is capped at the width of the strikes less the credit we receive. So again, what we would be doing in an iron condor is selling a call spread, selling a put spread, typically out of the money. And we're going to go through how we look at those strikes. Okay? This is what a P&L and the combination of the position would look like. We've got this put spread down here, okay, selling that, credit spread. We've got this call spread up here, selling that. And what that comes down to then is a P&L that looks like this. And I'll show you a live one with both NVIDIA and Salesforce. But essentially what we are looking for here is a stock to remain in a defined range. Okay, if we happen to move outside of that range, we don't want that to happen. But as I just mentioned, we are 100% risk defined. Okay, here's option chain for NVIDIA. Okay, stock 136. Okay, first thing, just like what we would do with any evaluation for any sort of position. And you know what? Before I do this, let me actually pull in the live NVIDIA chart here. And you know, you may have your bias whether you're bullish, bearish NVIDIA, but honestly, from both a technical, from a fundamental, and just from the news flow of what we've seen with earnings and what they may or may not say about guidance, if I look at this chart, there's nothing here that stands out to me that says, oh my God, I've got to be uber bullish, I've got to be uber bearish. Long term, I always want to be bullish NVIDIA. Something, you know, for me anyway, I hold in my portfolio just to have forever. But for a trade for earnings, there's nothing I see here. Okay, so how would I go about evaluating whether this is an appropriate trade or not? Okay, first thing we do is look at the expected move like we would do for any sort of setup. From what you guys see on the screen here, what do you believe is the expected move for NVIDIA this week? Anybody? Okay, about 10 bucks, 9.5. Yeah, good, good. So how do we do that? For those that don't know, it's kind of an easy one, especially with the stock sitting right at 136 here. If we look at the 136 straddle, call and put together, we're really at about 9.5 bucks. Okay, does everybody see 10? I would accept that too, Brad. No question about it. So if we were looking then at the expected range, we would say, let's call it 126 on the downside and 146 on the upside. Does everybody see that and agree with that? So if we're taking that at the money straddle, using that for the expected move for this week, we know that's elevated. We know the implied vol is elevated. Okay. We're getting basically a range of 126 to 146, give or take. When I evaluate whether an iron condor is an appropriate position, okay, what I want to do is look for strikes where my break even, okay, the break even on the trade would be at either end of the expected range. Okay, or very, very close to it. Now, regardless of whether you were to use $2 wide, $3 wide, $5 wide, $8 wide spreads, okay, what we're looking for is where your break even would be at those expected move points. So let's just play around here, okay? Let's just do something here. Let's say we were to sell the 128, 125 put spread on the downside, and we were to sell the 144, 147 call spread on the upside. Okay, so we have basically a $3 wide spread on both sides. What kind of credit could we get for that? Well, let's say that put spread, and NVIDIA is a great one to look at because the markets are so tight, pennies wide. So we can really get very accurate markets there. Let's say that's trading 63 cents. And let's say that this is trading right about the same. So the credit received would be $1.26 if we were to sell those strikes. And again, why am I choosing $3 wide? Completely random. I'm just basing and placing the strikes around that 126 to 146 area. Okay, everybody following? Because remember, 126 on the downside was pretty much the expected range. 146 on the upside was the expected range. Okay, so let's say we were to sell this for 126, and I'm going to just make it 125 for math purposes right now to make it real easy. So if we had a credit of $1.25, how do we know? How do we evaluate if that's enough? Are we getting paid for the risk that we're going to be taking here? Is $1.25 enough? Anybody besides Brad? Okay, nice, Milan. Nice, nice, nice. Yes, we need to know reward to risk ratio. So how do we do that? Well, first, if we start this knowing that we're collecting $1.25, what's our risk? What is our risk? Anybody? Thank you, Clive. Carlos, that is correct. So the maximum that this could ever be worth. So let's say the video went to 0 or it went to 200. Okay, it blew through the strikes on either side of the equation. The most it could be is $3. You guys all got that, right? So if the most is $3, which is the width of the spread, and we're collecting $1.25 of that, that means our risk is $1.75. So without even knowing where the break even is at this point yet, I'm going to tell you that if we take our $1.25, our reward, divided by our risk of 175, there is no chance I am selling this. That gives us a reward to risk of 71.5 or 0.715. For earnings, okay, for earnings on an iron condor, I want to see a reward to risk of close to 1-to-1. If it's not earnings, I'll accept a little less than that, maybe 0.8, 0.85 to 1. But right here, this is not acceptable to me from a reward to risk. Now, let's look at what those break-evens would be. Okay, the break-evens, we were a short of 128 and a short of 144. So our break-evens would be 126.75 on the downside and 145.25 on the upside. So in addition to the reward to risk not being sufficient enough, remember what I said at the beginning. I like to see the break-evens really close to the expected range. Okay, the expected range was 126 on the downside, 146 on the upside. I wouldn't do this. I just wouldn't do it. Does everybody understand this? Sure, we could move around the strikes a little bit. We could make this a bullish iron condor or a bearish iron condor, get more credit, get, the reward to risk. We can really get the reward to risk at any price we want it to be based on where the strikes are. But to really evaluate this, we have to evaluate it with the break evens being really close to the expected range on either side. Okay, let's look at Salesforce. Okay, same scenario. Earnings after the close today. Here is the option montage for Salesforce. Stock is 276 and change. Okay, we're going to say there's an expected move of about $20 plus. Does everybody get that? Everybody see that? Okay, so if we have that as our expected move, and the stock is currently 276, we're looking at, let's say, 256 to 296. Okay, 256 to 296. All right, let's set up an iron condor around those strikes there. So maybe that on the downside and maybe this on the upside. Again, I'm going $5 wide here. We could go $2.50 wide if we want. I'm just looking at strikes around the expected move ranges to get a gauge whether this is good enough or not. So here, let's say we could collect $1.20 on the put side And on the call side, let's say we could collect $1.15. So combined, we have a credit of, let's say we could do this for $2.35. Is that enough? Is that enough? How do we know? How do we figure that out? It's close. Okay. But you know what's that old term adage that we all kind of knew as kids? Close is not good unless you're playing what is it, horseshoes or hand grenades, right? Something like that. So in this instance, we have a 235 reward divided by a 265 risk. Does everybody understand why the risk would be 265 here? Okay, that puts reward to risk at 0.89. Much better than the NVIDIA one. Okay, and if this weren't earnings, then maybe I would consider it. Okay, so 0.89, which we know is a little light. What's our break evens? What's our break evens here? If on the put side, if we're selling this for 235, the break even down here would be 257.65. That would be the 260 minus the 235 credit. Does everybody understand that? And on the upside, it would be the 292.5 short call plus the 235 would put us at 294.85. Again, these are super close to what we calculated as the expected range. And maybe if I was able to get more credit, maybe if I was able to get 260 credit, better than the 1-to-1, I would do this. But again, here, I'm not getting 1-to-1. It's close. And I'm also falling short of where the break evens would be both on the downside and the upside. So you know what? I'm not going to force the trade. I'm just not going to force the trade. Does everybody get that? We know there's always another trade to make. And listen, is an iron condor the only thing to do if we're looking for something to stay range bound? No, it's not. It's probably the easiest to comprehend. Okay, so I'm not going to do it. We're just going to move on. We'll find something else to do. Okay. Hulk says today's word is range. And that's because in an iron condor, we are looking for the stock to be range bound. Absolutely, Bear. So that would be the next thing to look at. 100%. If we're still looking for something, kind of range bound, looking to go to one end or the other, where we're not directionally biased, yes. Double calendar, double strangle swap, 100%. That's what we would look at next. But that'll be a topic for another time. Okay. While you guys are typing in the range, any questions at all here? And again, an iron condor doesn't necessarily have to be put on as a position just to get to the expected ranges. That's when we're looking at a position where we're kind of right in the middle of a range. We don't know which way it's going to go. Iron condors can also be put on, as I mentioned before, with a bullish bias, a bearish bias. Okay, in fact, let me show you one that I'm kind of looking at right now. There's a stock today that got crushed. There's a report out there that there is a short report out on it. This TEM. Okay, let me show this to you. Okay, so look at this chart. Okay, whoop, there we go. Look at this chart here. What do I see? Well, I see this stock today crushed, but right down to an area where there's major support. Does everybody see the 50 and the 200 day right there? Okay, so if we were looking for a potential position where, okay, we're saying there's a lot of support here, where maybe we're not necessarily 100% bullish, but there's a ton of support and we're pretty confident that that support may hold. Okay, so if we look at that and we see what implied vol did here today, which there's a big spike up in implied vol. It's still not overly expensive, but a big spike up in implied vol here. We could look at something here. Let me bring in option chain. And since this one is not an earnings play, I'd probably look at next week. Okay, so if we were to look at TEM, it's trading 54 bucks. Expected move for next week is right around, let's call it $8. Okay, so based on the expected move and where the stock is right now, we'd be looking 46 to 62. But because of what we saw on those charts with really, really big support, okay, we could look at this, and here's one that we could put on for more credit with a bullish bias. And instead of targeting 46, which would be the expected range on the downside, maybe we just give it a little bit from here and we target 52. Okay, because of the massive support. So let's take a look at this. Let's say we did the 54.51, which you'll see is really selling an at the money put spread because we're that support right there. But then doing the 63 call spread. So $3 wide here, but look at the credit. Because we're using an at the money spread on one side, because of that bias, look at the credit. If we got $1.90 credit, what is our risk on this? If we got $1.90 credit, what is our risk on this? Exactly. It's only $1.10. You might look at that and say, man, oh man, that's unbelievable reward to risk. Right? 190 divided by 110, boy, that's 1.73 to 1. That's unbelievable. Well, why are we getting paid more? Why is that reward to risk more? Because the risk to the downside here with $1.90 credit, the break even would be 52.10 when the expected move is really 46. We're taking more risk. We're getting paid for it, but it's more risk because of that expected move to the downside. We're making it a very, very small window. Nonetheless, though, it's something we might do if we were really, really confident that this thing has bottomed out. Okay. And what it does on the upside with that $1.90 credit, it still gets us right to the expected move range. So I'm not going to suggest anybody go out and put this on right now. However, when we are finished here, if you come back into the room, it is something we're going to go through a little bit further. Does everybody understand that? All right. That was a good one, guys. Let's, and sorry for the camera issues early on. Let me get this off the screen. And this off the screen. Get back to the Hulkster. We'll get the wheel going. And everybody can then go grab some lunch and be ready for the Fed minutes coming out soon. Okay, let me get our wheel here. All righty. Here we go, everybody. Let's give it a whirl. Today's winner, is it Chris? Is it David? Chris or David? David Budd. David Budd, are you in the house right now? David Budd, there, boom, love it. Okay, I just posted up there an email. Please shoot me an email with your address, mailing address, and your size swag. Prosper swag at prospertrading.com. We will get that out as soon as we can. Nicely done. Any suggestions for topics for tomorrow? Any suggestions? Got lots of congrats. You guys are all really congenial. That's good. That's good karma. Naked puts and calls. Could do that. Naked. I'm writing this down. When to, oh, you know what, Bear, didn't you suggest that like a week or two ago? When to roll a position. Awesome. Okay. Thanks, everybody. Go grab coffee, lunch, whatever it is. You got Fed minutes coming out in a half an hour. Maybe we'll see a little bit of movement in the marketplace. GLD, I'm looking for an entry. If we get some really dovish commentary from the Fed minutes, we could see gold come down even further, rates come down, and maybe that'll give us an opportunity for an increase. When I look at the technicals, David, I'll look at 3, 6, 9, 12, 24 months. I'll kind of look at it all. All right, everybody. Thank you. Please subscribe, smash. I don't think I talked about that. Hit that like button. Love it, everybody. We will talk to everybody later on. Thanks, everyone. Bye-bye.